DCM Systematic, located in the blue-gray building right in the middle here in Geneva, is a FINMA-authorized and NFA-registered investment manager. DCM is a key player in the systematic investment space and is owned by Dr. Anthony Dearden, Dr. Jérôme Cailloux, who both worked together previously at Bluecrest, and Gaëtan Maraide, who was a senior executive at Pictet. The team combines excellent academic credentials in fields such as machine learning or robotics with deep investment experience, having been developing and managing systematic strategies since 2007 at blue-chip firms. DCM's flagship strategy was launched in February of 2016 and aims to deliver uncorrelated absolute returns through all market environments using a multi-strategy, non-trend approach to trade liquid futures markets. In this video, we'll meet the three founders who will explain how DCM applies scientific methods to identify a range of alpha diversified by asset classes and time frames. We also speak about the several layers of risk management DCM applies and how the firm, who has been an early adopter of machine learning, is using AI in practice today.
So I was wondering, what does DCM stand for?
DCM is named after the surnames of the three founders. So there's myself, Anthony Dearden, there's Jérôme Cailloux, and there's also Gaëtan Maraide. My background starts with a PhD in artificial intelligence and robotics at Imperial College. I joined Bluecrest Capital Management back in 2007, worked there in the systematic part for 6 years, and then left with Jérôme in 2013 to found DCM Systematic.
I'm Jérôme Cailloux. I'm the CEO of DCM Systematic. I'm a co-founder of the firm and also head of research. Together with Anthony, we have co-designed the diversified alpha strategy, and we have a long history of working together because prior to that, we were in the same team at Bluecrest, where I worked between 2008 and 2013. And I do have a background in applied mathematics and machine learning, which is still of my passion today, and we do a lot of that here.
I'm Gaëtan Maraide, the M of DCM Systematic. I'm the CEO and take care of the non-investment side of the business. My background is a law school in Belgium, and I joined the banking industry 20 years ago, and I founded DCM Systematic with my two partners, Jérôme and Anthony.
So tell me more about the entire DCM setup and the investment strategies that you run.
So we are DCM Systematic. We are a Geneva-based hedge fund, fully fledged license with the FINMA, the Swiss regulator. We are a team of 15 with 7 researchers inside of the team. We see ourselves as a research boutique, meaning that everything is set up for our researchers to do the best research they can. Let me speak about our 3 strategies. We have Diversified Alpha. It's our non-trend CTA, our flagship. This video will be about Diversified Alpha. We have a convertible arbitrage strategy called Solken that has been launched 2 years ago. And we have a last project in the pipeline, who is an intraday strategy that will be released early next year.
Well, what's a non-trend CTA?
So DCM Diversified Alpha is a non-trend CTA. So we decided back then, my two partners working at the large CTA, trend following shop, to do something different. Something that sits perfectly well next to established trend followers. Investor doesn't need DCM Systematic to invest in another trend following. So we decided to do something completely different and uncorrelated to the trends.
That's right, Gaëtan. But let me talk you a little bit more how it works. It's actually a multi-strat type of architecture. That means that we are blending many different sources of alpha, but none of them is about trend following. We are looking at different type of market inefficiencies or anomalies, and we have 3 main angles to do so. The first angle is what we call behavioral model. And these models are actually trying to anticipate how other very large market participants are trading and trying to take advantage of their market impact. The second one is relative value strategies, where we focus on different kind of spreads or kind of market neutral type of exposure on certain sectors. And that gives us some good edge because it's not a place where many large players can go. And the third category is macro models, where we look at perhaps a little bit longer term type of models or lead-lag relationship between different asset classes. So you see these three pillars all together are really complementary to trend following because they don't overlap with that. And anything that would have a significant correlation to trend would not be included in the program.
What instruments do you actually trade, and what would be a typical holding period?
So we focus on very liquid futures contracts, which allow the program to be very liquid. And we look at the four main asset classes, which are equity indices, including volatility, treasuries, like fixed income with tenors between 2 years and 10 years, commodities, so these are energies, metals, soft commodities, and agricultural products, and then FX. In terms of holding periods, I would say that on average is around 20 days, so you could call that a medium-term program. But if you look more in the different type of strategies, the behavioral models will be, for instance, faster than the others because they are anticipating in their nature, and so they need to be a bit more reactive. And at the opposite of the spectrum, you can think of more macro models that are churning much less frequently.
Could you also run us through your risk management?
So we look really at risk on an equal footing as generating alpha. For us, it's really as important to deal properly with tail risk events or market volatility than to forecast correctly the markets. We do have 25 strategies, and each of them is equipped with a specific risk engine. But let me first give you a top-down view of the risk management. So first is really to allocate risk to each of these 25 strategies. And to do so, we have a monthly process which will essentially take into account various constraints like the volatility that we are targeting. It's a 12% annualized volatility in the 1x version of the program. And then we will have some upper bounds on each of the asset classes. So that is, for instance, 30% on equities, 30% on commodities, 20% on fixed income, and 20% on FX. And then within each asset class, we have a certain number of strategies that belongs to the three styles we mentioned earlier. And the general rule there is to do a flat allocation and to give the same amount of risk to each model, with a few exceptions. There are, for instance, in the commodity space, there's a bit of an overweighting of the energies versus the rest, for instance. Or, for instance, we trade less natural gas within that group than the rest for risk constraints. But globally, our intent is to spread out the risk as much as possible. It is not to find out which model is going to be the best performer of next month, because we think it's extremely difficult, if not impossible, to do a market timing of our own models. So that's really the first objective, risk allocation to the 25 models. Second is really within each of the 25 strategies, there is a risk system that is very dynamic, and that will look at combining the forecast with various risk metrics that are, for instance, the volatility or the correlation between the assets. And we are plugging a number of constraints there, ranging from simple things like maximum position size that takes into account liquidity for the markets we trade, to something a bit more complex, which is about leverage, where we cap the maximum margin to equity ratio, for instance, up to things that are, I think, quite unique to DCM. Let me give you a good example. We have something we call worst case scenario protection. which is, I think, a concept everybody can relate to because it's really about stress testing your portfolio. I'm sure everybody that listen here has at some point tried to see what's the sensitivity of his portfolio facing a certain type of shock. And that's a good analytics, but what we wanted to do is take that one step further and not just having as an analytics, but as a way to hedge our exposure against something that might happen. We did have that before the COVID, we did have that before the Volmageddon, and that turned out to be extremely successful to not only protect the portfolio, but promote a risk-off type of positioning and implementing long VIX positioning there. So that's something we like because we see risk is not just turning down the volume once you've been hit, but it's also thinking ahead of what could go wrong and protect everything you can in your portfolio against that. We also have different things like stop loss control on each of the models, simply because when you have 25 models, you know that each of them are, looking at certain number of assumptions. And we know that the markets are driven by many, many drivers. And at times, a model can focus on something that's not the main driver. So you need to acknowledge that the model is imperfect, and you have to, in a systematic way, try to find a way that will reduce the exposure should the model underperform for quite some time. If that happens too often, that will lead to an investigation by the research team. But as a first line of defense, we have certainly various principles that will keep us away from tail risk and deal with the risk in a very disciplined way.
I was wondering, how often do you implement a new strategy into your program?
The multi-strategy architecture lent itself very well to a continuous process in times of research. We have a quant team of 5 quants plus a CTO, and we are very passionate about, cracking on new challenges, finding new sources of alpha, or ways to improve existing models and the risk system. So it's never for us a case that we are set in stone and that the model is perfect and you come back 2-3 years later, it's the same. It's always evolving. There's always new things on the table. But it's research, I see it really as something about the creative process where when you start something, there's no guarantee it will really succeed, but you have to keep on trying and learning things to get to something that works at the end of the day. So we typically have various types of research projects, ranging from what we call low-hanging fruits, which are typically things that are there and can be accomplished in a matter of a month or so. To give you an example, it can be applying an existing idea or strategy to new markets, or it can be refining a certain type of filtering, for instance, that we know works well somewhere else. Then we have, at the opposite of the spectrum, much more blue sky types of ideas, where it's something we've looked at for years now. It's the intraday type of models, where it's really different and more based on the machine learning type of approach, where you're trying really to find a signal within a notion of noise, which is typically the challenge that many quants are really eager to crack. And indeed, it's a challenge to take on. And it takes time, and sometimes you hit the wall and you have to come back, and it takes a lot of time. And in the middle, we have projects that are more of medium tenure that can span for 6 months to a year, and that can have a profound impact on the diversified alpha portfolio. So that's really more about how we categorize the research avenues. Now, how do we carry on the research really? Typically, there will be a lead researcher that will investigate a new idea or a new, perhaps, candidate strategy. We had a few additions last year One of them was about what we call shock impulse models, which are strategies or models that looks at overshooting effects. You know, what happens after a shock that is larger than usual on certain commodities. Is there an overshooting that is getting normalized, or is it creeping up or down like a breakout type of trades? So we've analyzed that, and somebody took that as this research piece, came with a prototype, and then the rest of the team got involved. And typically we call that the challenging parts. Like, our goal is to be a little bit critical in the scientific sense, like trying to find out if it's an artifact in the data. Is it really reproducible? Is it working all the time, or only when markets are in a risk-on type of environments? Is it overlapping with existing strategies? And what kind of risk factor is it exposed to? So this is really a back and forth between typically at least 2 or 3 members of the team, where a project can be either signed off or sometimes discontinued, because this is the game. I mean, you have to be able to take the critics and see if an idea will be repeatable and make money in the future. Once assuming that's signed off, there will be a review from a production type of point of view, more technological, from the CTO, making sure all the pipes are working. Do we need an extra monitoring on that? Are the data feeds correctly plugged in, etc.? And then there will be a paper trading phase that typically will take a month. So we get a feel for what it would do in real, in the markets, without taking any risk. Because we, of course, are very cautious about operational risk, which, you know, when you add up something new, it's better to monitor for a while. And once everything is safe from that perspective, we would start allocating a token little amount of risk for another couple of weeks or so, and then starting a ramping up to a nominal risk level.
And what benefits do you offer investors, or to put that in another way, how do investors use your strategy in their portfolio?
I think diversified alpha has been used in different kind of roles or function in a portfolio. We can be used as a pure alpha play. CTA allocators typically loves to invest with us because of the low correlation with their existing CTA. So that means that they can kind of grow their pockets to CTAs without doubling up on the risk and potentially mitigating the worst case or their drawdowns. So that's great. So there's other people who are using us as a tail risk protection. I mean, an element of that. We're not quite like an option, but still, if you look at the track records, which is now almost 9 years, we've been demonstrating in a few occasions that the program was really offering diversification when you need it. It's not just on a 30 years look back average that it's been delivering when equity markets had difficult times, but if you zoom in really specific times, and I have a few in mind, like the Q4 2018, the COVID, the Volmageddon, the start of the war with Ukraine. There's been occasions where you needed to have this offsetting property, where some CTAs haven't been able to offer that, and where we did. And I think it's good, and as a researcher, I really like to discuss that with the investors, because they come to us and we discuss openly what's going on. And at these very times, it was clear that we've been doing the job for them. We've been offering this kind of hedging component that they were expecting from us, and that's always very satisfactory from us. I think that stems a lot from our disciplined approach towards risk management. If you look at the track records, the max drawdown has been less than 1 standard deviation, where the industry typically expected 2 standard deviation. So that's very well contained, I would say. And our correlation versus many other benchmarks, CTAs, alternative risk premia, traditional investments, has been close to zero. I mean, it's probably around 0.2, 0.3 versus CTAs, and even lower to other risk premia type of indices. So in terms of what we really want to commit to for our investors is that they know that DCM, Diversified Alpha, stands in a special place in their investment spectrum. It's not overlapping with many things they already have in part or so. It's really something they can think of, okay, this is gonna be decorrelated, having an element of tail risk protection, and there's many sources of alpha baked into the program, and I have a clear view of what's the DNA of DCM.
What vehicles do you offer for investment? What options do investors have to go with you?
We have various ways to access the Diversified Alpha program. First, we have SMAs, where investors are managing their own liquidity. And we also have a few commingled structure where we do offer a leverage ranging from 1x up to 2.5x. And our flagship Luxembourg fund has a weekly liquidity.
In the last couple of years, we have seen phenomenal breakthrough with AI in the fields of large language models and image recognition. Do you expect similar breakthroughs, similar advances in the field of finance through AI?
Yeah, this is a very interesting question, actually. We have many people here who have embarked in the machine learning journey 15 years ago or more, when it was not hyped at all. And so it's quite interesting to see how the field has expanded through various things, including hardware acceleration and the access to very large data sets. So that's, as a researcher, fascinating. When I started in machine learning, it was also about kind of forecasting what comes next, like the large language model. Back then it was more about Markov models or hidden Markov models, but that was the same kind of case study to forecast what would come next and try to guess in the language to answer a question, for instance. And in finance, though, it's a little bit different because you're dealing with much less data, actually, that you have from the web. Something like ChatGPT is trained with trillions of tokens, where on finance you have much less observation, first, and second, there's much more noise, meaning that you cannot necessarily link a cause to an effect in such a clear-cut way. It depends. And third, there's a problem of stationarity, meaning that something that was true 10 years ago might have disappeared. Think of an anomaly in the market, in the pricing. You might have learned something from a data set that goes back 10, 15 years ago, and that has been arbitraged out by some players, and your model will still remember it was present, and it takes time for a model to understand something disappeared, something new is coming. So I would be a little bit prudent on the expectations here. I would not necessarily think you can translate this type of immense progress to finance directly. It still takes a lot of craft and knowledge of the space to correctly apply these machine learning or deep learning techniques such that they are dealing correctly with the noise and that they are not focusing too much on effects that have disappeared.
How do you actually use machine learning at DCM?
There are various ways we look at it. Certainly, as a research tool, it's being used a lot. It's not necessarily going to end up in a strategy, but it can, for instance, help us in our signal processing. Or another example that I find quite compelling is in regime switching, which is a concept where you know that the markets can transit from one state to another state, can be risk off or risk on, for instance, or high inflation, low inflation, or it can even be something you can't really describe with words. The internal structure of something has changed, and you need to apply another type of models for the risk or the forecast, for instance. And so instead of trying to understand purely what's going on, you almost give up a little bit on that, but you model the fact that there are certain states and probability to move from one state to another, and understand a little bit more what's the dynamics in these various configurations. So that's something we find quite interesting to analyze even after the effects, after the events, how certain models that we are using are behaving or performing. And we think it's very complicated to know for sure in which states you are, but something that's in the realm of what we can do is to make sure we are well covered. Like that if a certain model has a weak spot there, we have another model that will compensate for these weak spots. And that's the beauty of the multi-strategy approach, is that you don't need to have every single pieces to be exactly perfect. It's the together effects that must be complementary and bringing something that can indeed work well in many, many different regimes.